What we're going to do here is we're going to look at some processes to try and classify investors into different behavioural types. There's 3 processes we need to be aware of here. So why are we using these processes? Well, if we use these processes to classify investors into different types, some that may have behavioural traits that cause them to act too much, too quickly. Some investors might have behavioural traits that cause them to act too slowly, not act when they should. If we can classify investors, then we can identify the behavioural biases that they're most likely to exhibit. And once we've done that, we can incorporate, remember the discussion that we've already had about cognitive biases, we should try and educate investors about those. Emotional biases, we should try and adapt our asset allocation to deal with those, to mitigate the impact of those. We can incorporate these ideas into our investment advice processes. So classifying investors, the idea is, are we dealing with a potential hothead, or are we dealing with somebody who's potentially too risk averse? Knowing the characteristics of our client can help us to identify the types of biases that they're like to exhibit. Now, like I say, there's 3 processes that we need to be aware of, 3 models. There's a very simple one, the first one, the Barnwell two-way model. As the name suggests, there's really only 2 types of investor that we would classify investors as, 2 buckets, if you like, that we'd throw them into. A little bit more sophisticated is the BBK, Bailard, Beal and Kaiser model, or the Pompian model, which is a little bit more sophisticated. But they do have a lot of similarities, these 2 models, and so we can kind of, if you like, we can kind of present them together. So let's start with the most simple one first. Number 1, the Barnwell two-way model. Don't forget what we're doing here. We're trying to classify investors into what type of personality they are. The Barnwell two-way model really only has one dimension with 2 extremes, really. We are either looking at an active investor that's relatively confident, risk tolerant, ready to take risk, maybe looking at generating returns rather than worrying about the downside. The other end of the spectrum is a passive investor. A passive investor will be more concerned about losing money, more concerned about protecting wealth, and not quite so risk tolerant, a little bit more risk averse, if you like. Now, an active investor, how could we diagnose an investor as being an active investor? Well, one point that's made in the curriculum that's very important is that an active investor is likely to have generated their wealth themselves. They're likely, being an active investor, they're likely to have taken risk with their own capital. And what that means is starting your own company, taking risk with your own resources, your own money, your own time, your own sweat, and they've generated wealth themselves. That would classify them as an active investor. They like the thrill of taking risk. They like the idea of being responsible for generating returns, so they're likely to have higher risk tolerance. With that is likely to come this need to control their destiny. You might find that entrepreneurs that are active investors like to be in control of the decisions that they make. They like to feel like they're making decisions. If they feel like you're taking that control away from them, it might very well take away this high level of risk tolerance that they have. They might become more passive if they feel like you're taking control away from them and making decisions for them as an advisor. So just bear that in mind. So an active investor, if you're looking at somebody that's generated their own wealth, you'd classify them as an active investor under this model. So what's the other end of the spectrum? The other end of the spectrum is somebody who's generated wealth passively, not actively, but passively. So through salary, saving, salary and saving, or through inheritance. So this wealth has been generated through passive means. It's been kind of transferred to the client, the investor, if you like, without them actually putting their capital at risk. So they tend to have lower risk tolerance, these investors. They've built their wealth up not through putting it at risk of losing it, but they've built their wealth up patiently over time or passively through receiving it in inheritance. They haven't actually taken risks to get there. So keep an eye out for that. Like I say, a very simple model, the Barnwell two-way model. You're either active, entrepreneurial, used to taking risk, so you'll be more confident, more risk tolerant, or you've generated your wealth through passive means, through patient saving over time. Don't forget here you might have some relatively senior managers people that are relatively high up, but they're not actually entrepreneurs. They haven't actually started the company themselves. They haven't actually put their own capital at risk. They are still working for somebody else. Accountants, lawyers, professionals that you might consider as being relatively sophisticated, they would still be deemed to be passive under this model because they've taken a profession, they've taken salary, and they've patiently saved over time rather than actively starting their own business. Of course, if you had an accountant that started their own accountancy services firm, then yes, you'd treat them as an active investor. But somebody that's worked an accountant and just saved over time, you'd treat them as a passive investor. So what's the point of this model? It's a very simple model, but it gives you an idea of the kind of behavioural traits that these investors might exhibit. An active investor is going to be more risk tolerant. A passive investor is maybe going to be subject to the more kind of risk averse sort of regret aversion type behavioural traits that cause them to not act when maybe they should. All right, let's move on to the other two models, or let's move on to model 2 of 3. This is the Bailard, Beal and Kaiser model, or BBK model. This has got 2 dimensions to it. The first dimension is exactly the same dimension as the Barnwell model that we've just looked at, and that is investors can be put on this vertical axis here. They're either confident, think active, all right, it's a similar idea, confident, risk tolerant, active, or they're anxious and they're worried about the downside, and so they're more passive down here. So that's the y-axis here. So there is another dimension here. The other dimension is how they tend to make decisions. They're either careful thinkers, if you like, careful, methodical thinkers that like to process information, or they're impetuous, emotional feelers. All right, so that's an extra dimension. We're kind of saying, yes, you can have people that are more risk tolerant at the top, people that are less risk tolerant at the bottom, but also there's a spectrum of different behavioural traits, isn't there? We know that from the last reading. There's kind of cognitive behavioural traits that will be affecting those people that are more methodical, more thinkers and more careful, and there are emotional traits as well that are based on feelings. So this breaks our universe up into quadrants. There's obviously 4 quadrants here, you can see them on the page in front of you. We actually have 5 behavioural types here according to this model, the BBK model, because in the middle we've got the straight arrow, which is a relatively well-balanced individual. They're not too confident, they're not too passive or anxious, they're not too much methodical, and they're not too emotional. So the straight arrow in the middle is actually a very well-balanced investor that is likely to be a pleasure to work with, very understanding, accepting of advice, receptive of interaction, able to change their decisions through reasonable discussion. So they're not likely to be exhibiting too much of a bias if you like, too much of an extreme bias in any one direction. So let's have a look at the 4 quadrants. You should probably be aware of these names for these types of individuals and their likely behaviour. In the exam, I would argue that the form of the morning exam, if this comes up in the morning, which it normally does, the form of the morning exam is to usually give you these labels and to ask you which type, which label an investor is fitting. So just look and see whether they're methodical thinkers or whether they're emotional, and whether they are confident or whether they're anxious, and you can put them in their quadrant, and you have used this model appropriately. So what have we got here? Confident thinkers. We've got the individualist, their own person. The individualist, they are likely to be hungry for lots of data, but happy to take risk. All right, if they're confident that they're making the right decisions, if they're confident that the advice that they're getting is good advice, they're likely to be happy to make decisions. On the other side of the confidence spectrum, you've got the adventurer, a little bit more emotional. All right, the adventurer, willing to take chances once again, but might be prone to putting too much faith into a few ideas, might be prone to overconfidence, for example, which leads them to take too concentrated positions. Now on the more anxious side down here, the thinker is called the guardian. The guardian is, once again, very studious, very methodical in their analysis, but they're thinking about protecting the portfolio. But they're very, very much based on data once again and thinking when they're making their decisions. You might very well find that investors might drift into different quadrants over their lifetime. You might find that investors, as they get older, try and protect their nest egg, their assets, and they move towards a kind of a methodical guardian, having been maybe an adventurer or individualist early on in their life. The risk-averse emotional investor is referred to as a celebrity. Bit of a strange name, but if you imagine a celebrity worried, anxious about what people think about them, worried about treading the boards, appearing on TV, that sort of thing, worried about what people think. This celebrity here is very anxious about losing money, but it's based on emotion rather than on reason, cold hard cognitive thinking, if you like, and that's going to affect the biases that this investor exhibits. They are going to be the celebrity is going to be very anxious. They're going to need a lot of attention from the advisor. They're very emotional. They're going to feel like they're going to be relying on the advisor for almost like counselling to help them deal with their anxiety. So they're going to need a lot of attention and a lot of soft skills when advising them. So that's the general landscape here. I think the slides will back up the descriptions that we've been talking about. The adventurer, you'll remember, adventurer, kind of tally-ho, let's go, emotional, right, exciting and confident, yeah. And you can see there, as we've already said, that might lead them to take too concentrated positions. They could be difficult to work with, if they, if you like, if they believe their own opinion a little bit too much. If they're, don't forget, they're on the emotional side of the spectrum. Once again, on the emotional side of the spectrum is the celebrity. Don't forget they're down the bottom in the emotional side of things. Worried, they'll need a lot of help, emotional help, to deal with their anxiety. Some opinions may be open to investment advice if that alleviates their concern about markets. On the thinker side, you've got the individualist. They may want to make their own decisions, but they would be willing, don't forget they're thinkers, so they'd be willing to take advice as long as they feel like the advice is good and as long as they respect the advice that they're getting. So yes, they are willing to listen as long as they feel like the advice is worth listening to. They're the confident thinkers, aren't they? And then, do you remember what the non-confident, do you remember what the risk-averse thinker was called? Looking after their assets, that was the guardian, okay? Concerned about protecting the portfolio, willing to seek advice as long as they, understand the process and the advice is reasoned. And like I said earlier, you may find that investors shift towards more risk aversion as they get older, which logically one should. As you get older, you've got less time to recover from short-term losses, so you should become more protected. And you're going to rely on your assets more as you live in retirement. You don't generate income anymore through salary. So it might be a very perfectly, I say it might be, it is a perfectly rational thing to become more risk-averse as you get older. Don't forget, in the middle of this system, you've got the straight arrow, not leaning too emotional or too methodical, if you like, and not being too confident or too risk-averse. So they're likely to be a pleasure to work with. They're likely to be well balanced and understanding the investment process. Now look, here's something that I just want to emphasize at this point. The learning outcome statement here really focuses on the general idea of these processes, but it also focuses on the shortcoming of these processes, the issues with these processes. It's difficult to classify people. The learning outcome statement says, explain the uses and the limitations of these processes. The limitations of these processes revolve around the fact that every individual is different and individuals change over time. And, classifying individuals in these buckets, just labeling them like this is probably not, it's probably not really how, it probably doesn't explain the world in terms of how people actually behave. People are complicated beasts. Sometimes they can exhibit certain traits, and in other conditions they can change their behaviour. And when you try and diagnose them and label them like this, you might ask them questions. They might even answer those questions to give an impression that they want to give, rather than actually how they would behave in certain circumstances. So it is difficult applying these processes. It's important that you understand that the learning outcome statement wants you to know about those limitations. And here are some of them here. All right, people can change their behaviour in different situations. So that's the second system. The third system is probably the most comprehensive one. It's called the Pompian approach. They're all named after the people that came up with these approaches. The key thing about the Pompian approach is it's not just a model, but it's a full-on process, a full-on approach to sitting down with an individual, talking to them, understanding their psychology, their behaviour, and then putting them in a spectrum, if you like, putting them on the spectrum somewhere, and then thinking about the behavioural biases that they might exhibit. So this is the most comprehensive approach, but it has a lot of similarities with the second one that we just looked at, the BPK approach, because yes, there's 4 steps here, all right, to determine the behavioural investor type, to classify your investor, but actually a lot of it is common sense, and in the end they come out with kind of a two-dimensional classification system, which is very similar to the one we've just seen in stage 2. So the whole process here, for what it's worth, it's very common sense. To get to know your client, you've got to talk to them. Sit down, interview them, ask them questions. This is something that is always the first stage of classifying an individual investor in terms of their behavioural profile. And the first thing you're going to do is classify them on the kind of confident or not confident, anxious spectrum. So once again, similar to the Barnwell model, you've got this dimension of active versus passive. I say similar to the Barnwell, similar to both models that we've seen so far. They've both had this active or passive spectrum. Are they confident? Are they looking up? Are they willing to take risk? Or are they passive? Are they looking down? Are they worried about losing money? It's that sort of idea. The second step in this process is to plot them somewhere on that risk tolerance scale. All right, they're either right at the far end of the active spectrum, or the other end, passive, or they're somewhere in the middle. And then you're going to test for behavioural biases. Now that you've got an idea as to whether they are risk tolerant or whether they're risk averse, you're going to start looking for the types of biases that these types of investors might exhibit. So these tests, you might just be asking them questions that aren't even related to financial markets investing necessarily, but you're asking them questions about how they make decisions in certain circumstances to see if you can find evidence for cognitive or emotional biases that we've discussed in a previous reading. Then once you've come out with these results here, you're going to plot the investor somewhere in this spectrum. There's one of 4 behavioural investor types that are relevant here. The good news is that they do, the types that come out with the Pompian approach, the types that come out are very similar to the types that come out for the BBK approach, the previous model. So let's just remind ourselves at this stage, of the BBK model. Do you remember there were 2 dimensions? This is going to work for the Pompian approach as well. Do you remember with the BBK model we had kind of the confident guys at the top, risk tolerant. We had the anxious investors at the bottom. So that's your kind of risk tolerance, your active versus passive idea. And then we had thinkers over here, so cognitive biases over here. And we had feelers over here. We had the more sort of emotional, they referred to it as impetuous before. Impetuous means you're kind of driven by emotion, rather than thought. So can we remember what these were called under the BBK model? Can we remember? It's a good time, isn't it, to revise that? What did we call the thinker that was confident? What did we call them? We called them an individualist. This is the BBK model. All right. What did we call the thinker that was anxious? What did we call them? We called them a guardian. Over on the emotional side, do you remember the confident, emotional, huzzah, let's go type investor? They were an adventurer, weren't they? Yeah. And do you remember the anxious, emotional one that needed a lot of support and really was, was very worried? you remember what they were called? They were called a celebrity, weren't they? Worried about what people thought of them, you know, anxious sort of thing. All right, now that's the BBK model. The nice thing about the Pompian model is that we do get, now don't forget the straight arrows in the middle for the BBK approach. Yeah, it's important not to forget that. So the straight arrow is in the middle for the Pompian approach, for the BBK approach. Straight arrows in the middle for the BBK approach. For the Pompian approach, let's change the pen to red. For the Pompian approach, we are going to have these two axes again. That's why I've drawn them again. And the good news is, under the Pompian approach, there are similarities. For example, the confident, top left here, the confident thinker is referred to as an independent individualist. Okay, so that's very, very similar, isn't it? Because it's got the word individualist in it, and it's the same idea. They're a thinker, but they are, willing to take a risk. Okay, the independent individualist. Over here on the right at the top, where it's the adventurer under the BBK model, we're going to call them under the Pompian approach the active accumulator. Now that's relatively easy to remember. Hopefully, you've got the adventurer, A for adventurer, A for active accumulator. That can you can kind of tie those two up in your mind for the exam and think, yeah, adventurer or active accumulator, these are your more emotional kind of tally-ho, charge sort of thing, let's go. I more imagine them on a horse, riding into the investment markets with excitement. So that's, you can remember the letter A there to remind you. Down here we've got the risk-averse investors or the anxious investors, the more passive investors. The thinker, it was called the guardian under the BBK model, protecting the assets through thinking carefully. Under the Pompian model, it's called the friendly follower. So the friendly follower, why do they call it that? They call it that because this thinker who's risk-averse is likely to follow good advice. Because they're risk-averse, they're going to feel like they need good advice, and they are likely to follow it and be friendly and follow that advice, but they're going to be very, they're going to need a lot of reassurance, and a lot of thought goes into their decision making. Now the way I always remember these two together, I always think of your guardian angel following you around and looking after you. So if you you can tie up a guardian angel sort of on your shoulder, being friendly, following you around and being your friend, then hopefully those two will fall into the same quadrant in your mind when you're trying to remember this stuff. And over here on the right, at the bottom, you've got the celebrity under the BBK model who was anxious and emotional. Under the Pompian model, we're going to call them the passive preserver. All right, they're clearly passive because they're down the bottom of the table here. They're down the bottom of the screen here. But they're likely to be very anxious and just focusing on keeping what they've got in a very emotional way, rather than being willing to take risk, even when it's maybe a rational thing to do. Okay, so there you go. That's the important thing to do, is to put those two systems on the same page together. Then you can see that they are pretty much the same thing. There's no straight arrow idea under the Pompian model, but you will see that if we go back to the Pompian model, these behavioural investment types of the Pompian model, yes, here they are. Passive preserver, all right, you'll remember they were bottom right. They were the risk-averse, cautious and anxious, emotional warrior, all right. Now, if you are dealing with a passive preserver, don't start talking to them about Sharpe ratios, standard deviations. Don't hit them with a lot of technical stuff. Focus on the big picture, all right. Focus on meeting their goals, which could be very much focusing on not losing wealth. And once you can try and convince them, maybe once they've got a level of security, you could try and convince them to take risk after that. All right, with assets that they have in excess of what they feel they absolutely need. They've got emotional biases, these passive preservers. Okay, so with regards to the types of emotional biases that you would expect, we're a worrier here. Maybe they're driven by regret. Remember regret aversion. They're worried about what could go wrong, that sort of thing. Next up, we know there's the friendly follower. They're the thinker that's still risk averse. All right, thinker, cognitive biases, low to moderate risk tolerance. They will follow advice. They might well, though, follow short-term trends and fads. All right, they do respond to advice, but they do also need education to understand. That's why they've come to the advisor for advice. At the risk-tolerant end of the spectrum, as we've already said, it's good news that under the Pompian model, you've got the individualist, that's the thinker, that's willing to take risk. All right, they will respond to education. They will respond well to advice that they think is adding value. All right, so they will listen as long as they feel like the advice is worthwhile. And then you've got the active accumulator. They're more emotional. Okay, high risk tolerance. They were called the adventurer under the BBK model. Okay, they're likely to be maybe a little bit difficult to advise because they want to keep control of their investments. They might think that they're better than they actually are at investing. Overconfidence is the classic bias here for an active accumulator. Incidentally, I'll just give you a word of advice. If you do look in the curriculum, you'll see that there's lots of the behavioural traits that we've seen in Reading 8 that are listed for these different types of behavioural investor types that we're listing here. I just don't see people getting paid on exam day in the morning for being a guru on that stuff. And it will take a lot of effort to remember all of that stuff because they're listing, 4 or 5 in each one. The key thing for you is to take away, look at the LOS. The LOS says discuss, it will explain the uses of these models and the limitations of them. Explain the uses and the limitations of these models. So rather than forensically learning, every detail about these models, take away the big picture, which is, largely this, with regards to how the models fit together. All right, there's another graphic. That's another way of summarising the Pompian model, but we've done that on the whiteboard here. The other thing I would say is this is a key slide. All right, this is what the LOS actually draws you towards. And that is that these classification systems, nice idea and useful, but not perfect. Okay, they do have their limitations. And that is that each individual investor is a broad mix of different types of biases. So to discreetly say, oh, you're overconfident, but you're not something else, you're overconfident, but you're not loss averse, that's being a little bit too binary, a little bit too discreet with the world. People tend to have a mix of biases. They don't necessarily fit into boxes, all right? And their biases, as we've already said, don't forget, one of the key problems is that their biases can change over time and in different circumstances. It's all very well and good, isn't it, sitting down with your client and asking them fewer questions whilst they have their coffee in your office, and they'll ask it as rationally and as sensibly as they can. But put them under a bit of pressure. Do they say, I want out? It's very difficult to actually know how your client is going to behave under different circumstances. For those of you, a good analogy here, I think, is soccer. England, the England football team has a long legacy of going out of international tournaments through penalties at the end of a game, when it's a draw at the end of full time and then it goes to penalties, and the England team hasn't got a very good track record of staying in those tournaments. And it's one of those things, isn't it, that actually the press will say, why don't you practice penalties more, to the England team? And the point is, you can't practice taking penalties in a World Cup quarter semi-final. You can't do it. It's not possible. You can only go to the training field and practice a penalty. You can't practice that scenario where the pressure comes. So, that's what I always think of when we're trying to work out a behavioural type. We don't actually know how they're going to behave under pressure in different circumstances. And that's not just the downside, but also the upside as well. We're not going to know really how they're going to feel about a big gain until that big gain is real and it's there. And then they might resist selling it, or they might sell it too soon, that sort of thing. The other thing is that, they can shift their behaviour between rational and irrational. And certainly when you ask questionnaires to try and classify your investor into one of these boxes, like I mentioned earlier on, the temptation for certain people might be to give the answer they think the investment advisor wants to hear. rather than give the true answer, which reveals their personality. So these are all problems with these systems. And let me just pause for a moment with regards to the exam, because you're right at the start of your level 3, or I'd assume most of you are close to the start of your level 3 studies. And you might not yet be fully au fait, fully familiar with the new style of questions and why level 3 remains hard, even though the content of it is not technically difficult. I think this is a good example of why level 3 is hard, because you might be in the morning paper and you might see a question that just says, hey, 2 minutes, give me, just state, it won't say give me, but it will say something like, briefly describe 2 limitations of the behavioural investment type system that is being used in this scenario, in this case study here. And a lot of people will flunk that question if they haven't prepared properly. You see, they've kind of come through level 1 and level 2 and they're forensic on the detail of the model. They've learned things rote, they've learned formally and things like that. And what they haven't paid attention to is that level 3 is a lot more holistic. It's a lot more, okay, there's this system, but what are the issues with it? What are the issues with this system? And then, so they get asked, state 2 or just briefly describe 2 limitations of a behavioural investment in a behavioural investor type process. Briefly describe 2 limitations of this. And they blank. They think, well, there's something I can't remember, and then they don't know what to write. There's something here that I can't remember what to write. And they don't have the capacity to actually use common sense. Because if I drag somebody off the street and said, hey, when you're trying to work out what somebody's like, what's a key problem? There's someone that hasn't read any CFA level 3, they might say, well, if you're trying to work out how someone's like, you might ask them some questions. If you're trying to work out their personality, then they might lie to you, or they might pretend there's someone that they're not. Yeah, that's right there. They might, give answers to questions that don't really reveal their true behaviour. Or everybody's different. It's difficult to classify people into discrete buckets. So this is the this is the important thing, is to always keep your common sense radar switched on, and in the exam to write something sensible that's hopefully you're very confident comes from the curriculum, comes from the curriculum, but if not, you're very, very confident it's coming from the curriculum, and just briefly justify it, and you're doing the right thing on average. So final bullet point here is that every client is unique. That would come through in a common sense observation as well. It's difficult to classify people with labels because every investor is unique. And the other thing I haven't explicitly mentioned here is that, yes, you can classify people as being, overconfident or risk-averse, too risk-averse, regret-averse, if you like, but that doesn't really help us to solve the problem. Make sure you're aware of the 3 systems, okay? Barnwell, BBK and Pompian. Make sure you know the labels that are out there. Make sure you know the limitations of these systems. And that's what you need to know for this module.